The very structure of global markets is shifting beneath our feet, and almost nobody outside the top 1% of institutions is paying attention. What if the dominoes that are about to fall in the ETF space don't just create another investment vehicle, but trigger a rewiring of how capital flows into crypto? And what if, buried in all of this, XRP finds itself in the eye of the storm, positioned not as a speculative altcoin, but as the settlement layer for a new 5-year liquidity cycle? That's the story we're unpacking today, and if you're holding even a modest bag of XRP, you'll want to understand every detail, because the next move could blindside everyone who's not prepared. Before we go deeper, let's be clear. Nothing in this video is financial advice. This is for educational and entertainment purposes only. Investing in crypto carries risk, and you should always consult with a licensed financial advisor before making financial decisions. What we're doing here is breaking down the data, the macro forces, and the structural shifts shaping this market so you can think critically for yourself. Now let's talk ETFs. To most retail investors, the phrase ETF approval just sounds like another bullish headline. They imagine more money flowing in, price going up, and that's where the thinking stops. But under the hood, ETFs are pipelines. They are mechanisms that allow entire classes of investors, pension funds, retirement accounts, endowments, insurance pools, to access assets they otherwise couldn't touch. And the mechanics of how those ETFs source liquidity can radically shift supply and demand dynamics in the underlying asset. When the first Bitcoin spot ETFs launched, we saw this effect in real time. Market makers had to buy actual Bitcoin to match inflows. Billions of dollars poured in, and even with Bitcoin's deeper liquidity, the price reaction was immediate. Now imagine that dynamic with XRP, which has a smaller market cap and a much thinner tradable float on exchanges. Even a fraction of those flows could move price far more aggressively. That's why ETF dominoes matter. They don't just represent new headlines, they represent structural demand that compounds over time. But ETFs are just one domino in a much larger chain reaction. To understand why XRP may be uniquely positioned, we need to step back and talk cycles. For years, crypto investors have been conditioned to believe in the 4-year halving cycle. Bitcoin halves, liquidity floods in, alts follow, rinse and repeat. That pattern has worked until now. Macro strategist Raoul Pal and others have argued that the old cycle may be breaking down, replaced by something new. A 5-year supercycle driven not by halving events, but by global liquidity flows tied to debt rollover, rate cuts, and fiscal expansion. Why does this matter for XRP? Because liquidity waves are the oxygen of risk assets. When central banks ease, when debt maturities force refinancing, when fiscal policy injects capital, all that money has to go somewhere. Stocks absorb some, bonds absorb some. But increasingly, crypto has become the high beta destination for capital-seeking asymmetric upside. And unlike previous cycles, crypto isn't just Bitcoin and Ethereum anymore. Institutions are diversifying. They're looking at assets with defined use cases, with settlement rails, with compliance-friendly structures. XRP checks every box.
Think about how institutions allocate. They don't just chase momentum. They model risk, liquidity, and utility. Bitcoin gives them store of value. Ethereum gives them smart contract exposure. But for cross-border settlement, for tokenized assets, for bridging fiat systems into blockchain rails, XRP is the obvious candidate. It's fast, cheap, scalable, and neutral. That utility is what elevates XRP from a speculative token to a systemic asset in the eyes of institutions. And once ETFs open the door, allocation can scale from millions to billions almost overnight. Let's connect this with the psychology of retail. Most retail investors are still anchored to old narratives. They think in terms of penny to dollars moonshots. They chase hype cycles, not macro flows, which means they'll likely miss the quiet accumulation phase happening right now. While retail panics over short-term dips, institutions are methodically building positions, taking advantage of every consolidation range to add exposure. That's the transfer of wealth in action, from the impatient to the prepared. Now here's where the 5-year cycle matters. If Raoul Pal's framework is right, we are not heading into a quick blow-off top like 2017 or 2021. Instead, we're in a stretched liquidity arc that builds more slowly, peaks later, and sustains higher valuations for longer. That means XRP's trajectory may not just be one parabolic burst, but a series of waves that compound over the next 24 to 36 months. Each ETF approval, each institutional corridor going live, each liquidity injection acts as fuel for the next leg, and the new floor after each wave rises higher than before.
Consider the numbers. Global pension fund assets exceed $50 trillion. Insurance companies hold another $30 trillion. Sovereign wealth funds add tens of trillions more. Even a 0.5% allocation into crypto across those pools would unleash hundreds of billions in demand. Bitcoin and Ethereum will capture some, yes. But if even 5 to 10% of that allocation finds its way into XRP ETFs, we're talking tens of billions in structural demand. And remember, XRP's float on exchanges is thin. When that demand collides with limited supply, price doesn't crawl upward, it leaps.
Let's pause here and talk about disbelief, because it's one of the most powerful forces in markets. Right now, disbelief dominates the XRP narrative. The token has underperformed flashy meme coins. The legal battles have dragged on. Retail is bored. Many have written it off. But that disbelief phase is precisely where the biggest moves are born. It's the setup. By the time the mainstream narrative flips, by the time CNBC is running headlines about XRP ETFs and tokenization corridors, the price will already have repriced multiples higher. Those who wait for confirmation will be forced to chase.
This brings us to tokenization, a theme that can't be ignored. BlackRock, Fidelity, and others are not experimenting with tokenization because it's trendy. They're doing it because it's cheaper, faster, and inevitable. Real estate, treasuries, stocks, even money market funds are being tokenized. And what's the bottleneck in tokenization? Settlement. You need a neutral, fast, liquid bridge asset to move value seamlessly between tokenized and fiat systems. XRP is designed for exactly that. It's not theory anymore. Pilots are live, corridors are operating, and institutions are building on this infrastructure. So let's connect the dots. ETFs open the door for institutional flows. Tokenization creates real-world utility and demand. The 5-year liquidity cycle extends the runway, and disbelief keeps retail sidelined until it's too late. All of these forces converge on XRP, creating the conditions for what could be the most asymmetric move of this entire bull run. Now, skeptics will argue, we've heard this before, XRP has been hyped for years, and they're not wrong. Hype cycles have come and gone. But the difference this time is infrastructure. In 2017, XRP ran to over $3 on hype alone, with no ETFs, no tokenization, no ISO integration, no regulatory clarity. In 2021, despite lawsuits and uncertainty, XRP still managed explosive bursts. But today we're seeing systemic adoption. ETFs are filing, tokenization pilots are scaling, regulatory frameworks are aligning, and global liquidity is shifting in ways that favor risk assets. The foundation is entirely different. So what does this mean for you as an XRP holder? It means you need to think bigger than short-term price targets. This isn't about whether XRP goes from $0.50 to $1 next month. This is about positioning for a multi-year structural re-rating of the asset. It's about understanding that when ETF dominoes fall, when the 5-year cycle peaks, XRP could be sitting not at $1 or $3, but at double-digit baselines that reset the entire market's perception of value. And here's the kicker. It won't happen in a way that feels comfortable. It never does. The big moves always come when disbelief is highest, when sentiment is weakest, when retail is least prepared. That's the psychology of markets. That's how wealth transfers happen, and that's why the next move could blindside everyone who isn't paying attention. Let's dig deeper into why the ETF domino effect could be the single biggest trigger for XRP's revaluation in history. To understand it, we need to break down how ETFs actually operate behind the scenes. When an ETF receives inflows, say $1 billion from institutions, the ETF provider doesn't just sit on cash. They create new shares of the ETF. And to back those shares, market makers have to go into the spot market and acquire the underlying asset. For Bitcoin, this has already meant billions of dollars in direct spot buying pressure. For Ethereum, the same effect is beginning to play out. Now extend this to XRP. With a thinner float, smaller market cap, and a far higher percentage of tokens locked away in escrow or in long-term holdings, The price sensitivity to ETF flows could be dramatic. And remember, ETFs aren't one-off events, they build momentum. The first approval creates legitimacy. Legitimacy attracts inflows. Inflows create price action. Price action creates headlines. Headlines attract more inflows. It's a feedback loop. That's exactly how Bitcoin ETFs cascaded from skepticism to billions in inflows within months. And with XRP, that loop could move even faster because the demand shock will collide with constrained supply. Now, let's overlay the 5-year supercycle framework. If debt maturities, fiscal expansion, and rate cuts are stretching this cycle, then the ETF approvals aren't happening in isolation. They're syncing with a rising liquidity tide. That's why this moment is different. In previous cycles, institutional infrastructure lagged behind. By the time retail FOMO peaked, there weren't enough compliant pathways for institutional money to scale in. This time, the infrastructure is ready. Custodians, ETFs, tokenization pilots, regulatory clarity, all converging at the same time. Liquidity is surging. Think of it like a perfect storm. On one side, you have macro forces, central banks cutting rates, governments rolling over trillions in debt, liquidity injections searching for yield. On the other side, you have institutional pathways, ETFs, custodians, compliance rails. In the middle, you have XRP, a settlement asset with proven real-world utility and a thin exchange float. When those forces collide, the repricing can be violent, sudden, and permanent. But here's the fascinating part. Most of this will be invisible to the average investor until it's already underway. They'll see headlines about an ETF approval. They'll notice XRP jump a few cents and shrug. What they won't see is the billions quietly flowing in through regulated channels, the market makers scrambling to source liquidity, the float being drained day after day. And by the time the move becomes obvious, by the time XRP is breaking into new all-time highs, it will be too late to position at the best levels. Let's bring in the psychology again. Markets move not just on math, but on emotion. Fear and greed are the twin engines of every cycle. And right now, fear dominates the XRP narrative. Retail is fatigued. They've watched meme coins pump, while XRP grinds sideways. They've lost patience. That's exactly when institutions like to accumulate, because they understand something retail often forgets. Wealth is built not during the fireworks, but during the boredom. When nobody is paying attention, that's when positioning happens. Now, let's zoom in on tokenization again, because this is where the story shifts from speculative to systemic. BlackRock has publicly said that tokenization will be the next evolution of markets. We're not talking about fringe experiments. We're talking about trillion-dollar asset managers, sovereign wealth funds, and global banks preparing to move entire categories of assets onto blockchains. Real estate, equities, treasuries, commodities, all tokenized. And tokenization doesn't work without a neutral settlement asset. You can't have trillions in tokenized assets flowing globally without efficient bridges. That's where XRP's ledger is uniquely positioned. Fast, cheap, scalable, neutral. Exactly what tokenization rails need. Picture this scenario. A pension fund in Europe tokenizes a portion of its bond portfolio. An insurance company in Asia tokenizes part of its real estate holdings. A sovereign wealth fund in the Middle East tokenizes its equities exposure. All of these tokenized assets need to settle, swap, and flow across borders. They need interoperability. And what asset provides the bridge? Not Bitcoin, too slow, not Ethereum, too expensive. XRP is built for this role. And once ETFs give institutions compliant access, the dots connect seamlessly. Here's the kicker. Institutions aren't waiting for retail permission. They're building quietly in the background. Every pilot, every corridor, every custody solution is another brick in the wall. Retail will wake up when the wall is already towering. That's why the narrative of disbelief is so powerful. It blinds people to the structural shifts happening right under their nose. By the time they see it, the move has already happened. Now let's widen the lens to macro again. The Fed is cutting rates. Inflation, while sticky, is trending lower. Liquidity injections are picking up globally. Japan, Europe, the US, all easing in various forms. These liquidity waves don't just lift traditional markets, they supercharge risk assets. And in an environment where ETFs are funneling billions into compliant crypto vehicles, XRP sits in the sweet spot. The liquidity is coming whether retail believes it or not. The only question is which assets capture it. So let's talk numbers again. Imagine just 1% of global pension funds allocate to crypto ETFs. That's hundreds of billions. Let's say 10% of that finds its way into XRP. a conservative estimate given its settlement utility. That's tens of billions in demand. Against a thin float, that's enough to reprice XRP into double digits almost overnight. And that's just pensions. Add in insurance, sovereign wealth, endowments, family offices, the numbers grow staggering. Here's the uncomfortable truth. Most retail investors won't be ready. They'll second guess. They'll say XRP has underperformed for years. Why would this time be different? They'll wait for confirmation. And then, when XRP is already $8, $10, $12, they'll chase in. That's how wealth transfers happen. From the hesitant to the prepared, from the impatient to the disciplined. It's as old as markets themselves. Now, before we wrap this section, let's touch on something critical: volatility. XRP's path to double digits won't be smooth. There will be sharp pullbacks, whipsaws, and shakeouts. That's by design. Institutions use volatility to accumulate. They shake out weak hands, scare retail, and reload at better prices. Don't confuse volatility with weakness. Volatility is the signature of a maturing market. In fact, it's proof that big players are involved. And as ETFs scale, that volatility will serve as the mechanism by which supply gets transferred from retail to institutions. So, where does this leave us? We have ETF dominoes about to fall. We have a 5-year liquidity cycle stretching the runway. We have tokenization creating systemic demand. And we have retail disbelief providing the perfect setup, all converging on an asset designed for settlement at scale. XRP doesn't need hype to move. It needs the math to play out. And the math is already in motion. Now let's pivot to the broader market structure, because it's not just XRP's fundamentals or ETFs that matter. It's the ecosystem of liquidity and psychology that surrounds them. Consider Bitcoin. For years, Bitcoin was treated as the only serious crypto asset. Institutional investors dabbled in it while ignoring everything else. But the tide has shifted. Ethereum ETFs cracked the door open for altcoin legitimacy. Solana is being tested in payment rails. Even smaller projects are being wrapped into tokenization experiments. And in that context, XRP stands out. It's not chasing the smart contract narrative or meme coin hype. It's quietly anchoring itself as the settlement layer for the new financial order. That difference matters because it positions XRP as a complement to Bitcoin, not a competitor. Let's break down what happens when multiple ETFs launch. At first, inflows are cautious, a few million here, a few million there. But once performance kicks in, allocations accelerate. Remember, institutions are herd animals. They're incentivized not to miss the move. Missing a major allocation is a career risk. That's why you see stampedes once the first movers confirm gains. We've seen this in equities, commodities, and now crypto. And with XRP, the herd dynamic could be even stronger because the upside is asymmetric. A small allocation can generate outsized performance. That's catnip for fund managers. Now, let's overlay the supercycle lens again. If Raoul Pal is right about the extension of debt maturity stretching the business cycle, then what we're witnessing is not the end of a cycle, but the midpoint. That matters, because midpoints are when positioning happens. The early mania is behind us. The blow-off top is still ahead. And in between, there's a quiet window where institutions build. That's exactly where we are now. The headlines may scream about short-term volatility, but the structural forces are about long-term accumulation. And this is where retail psychology can betray investors. Retail expects fireworks. They want overnight pumps, meme coin moonshots, instant gratification. But institutions don't play that game. They're patient. They allocate over quarters and years, not hours and days. That's why the disconnect between retail boredom and institutional positioning is so dangerous. By the time retail realizes what's happening, the re-rating will already be complete. Now let's expand the conversation to global macro again. The dollar is under pressure. De-dollarization isn't just a meme. Nations are actively exploring alternatives for trade settlement. The BRICS bloc is building currency alliances. Central banks are stacking gold. And in that context, neutral settlement assets like XRP gain credibility. Because while nations may disagree on politics, they all agree on efficiency. They want rails that are fast, cheap, and neutral. That's the niche XRP fills. It's not about ideology, it's about math. So imagine the convergence: ETFs funneling institutional inflows, tokenization creating systemic demand, de-dollarization creating geopolitical demand, all colliding with a thin exchange float. That's how supply shocks happen. Not because tokens magically disappear, but because the available float gets absorbed by forces larger than retail can imagine. When that happens, price has only one option: to reprice violently higher. And here's where Flare quietly enters the picture. Most retail investors don't even know what Flare is. They think it's just another altcoin. But Flare is building smart contract functionality that directly connects to the XRP ecosystem. Think of it as the programmable layer on top of the settlement layer. If XRP is the plumbing, Flare is the toolkit that lets developers build new rooms, new corridors, new systems on top. That's important because institutions don't just want static settlement. They want programmable liquidity, cross-chain integration, and composable financial tools. Flare is quietly positioning to deliver exactly that. So while XRP provides the settlement backbone, Flare adds a multiplier effect. That's why we can't just view this as a single asset story. It's an ecosystem story. One token may be the bridge, but the surrounding infrastructure amplifies its utility. And when that utility scales, valuation follows. Retail will wake up to Flare the same way they woke up to XRP years ago. Only this time, the adoption curve will be faster because institutions are already plugged in. Now let's talk mechanics again, because the details matter. XRP has a maximum supply of 100 billion tokens, but much of that is locked in escrow or held by Ripple. Of the circulating supply, a significant portion sits in long-term holdings that rarely move. That means the float on exchanges, the actual liquid supply available for trading, is far smaller than headline numbers suggest. Estimates suggest less than 10 billion XRP are truly liquid at any given time. Against billions in daily demand from ETFs or tokenization flows, that's paper thin. It's why volatility is inevitable. Picture this: a new XRP ETF launches and pulls in $2 billion in its first week. Market makers scramble to source tokens, but the exchanges only have a few hundred million liquid at scale. The order book's thin, bids push higher, sellers hold back, waiting for better prices. Suddenly, XRP gaps 20%, then 30%. Retail thinks it's a pump, but it's not. It's structural repricing. That's the difference most investors miss. The move isn't about hype, it's about mechanics. Now let's address the skeptics. They'll say XRP has been underperforming for years. They'll argue that other assets are more exciting. But that's exactly what creates the setup. Underperformance breeds disbelief. Disbelief creates weak hands. Weak hands sell cheap tokens. And those cheap tokens are exactly what institutions scoop up quietly. That's the cycle. By the time skeptics change their tune, the re-rating will already be complete. So where does this leave us in practical terms? If the ETF dominoes fall in sequence, we could see multiple layers of demand stack. First, ETF inflows create direct spot buying. Second, tokenization pilots scale and require settlement rails. Third, macro forces push capital into neutral assets. And fourth, Flare amplifies the ecosystem with smart contract capabilities. That's a four-layered demand stack hitting an asset with a thin float. The math doesn't just suggest upside, it screams it. Now let's step back and talk about cycles again, because timing matters. If this really is a 5-year super cycle, then 2026 is the likely peak. That gives us 2 years of runway. 2 years of ETFs scaling, tokenization growing, liquidity expanding, and disbelief fading. 2 years where institutions quietly accumulate while retail hesitates. And then, in the final phase, retail floods in at higher prices, chasing headlines. That's the blow off top. That's when you'll see 20, 30, maybe higher. Not because of hype, but because of math. But here's the irony. The biggest profits won't go to those who chase in 2026. They'll go to those who positioned in 2024 and 2025 during the boredom phase. That's the lesson of every cycle. Wealth is transferred from the impatient to the patient, from the distracted to the focused, from retail to institutions. The script doesn't change. Only the actors do. So ask yourself, where are you in this script? Are you bored, doubting, waiting for confirmation? Or are you accumulating quietly, understanding the setup before it becomes obvious? Because when the re-rating comes, there won't be time to think. There will only be time to react. And those who react late always pay the highest price. Now, as we bring this full circle, let's step back and frame everything in terms of legacy. Every few decades, financial markets go through a redefinition of what money, settlement, and trust mean. In the 1970s, it was gold decoupling from the dollar. In the 1990s, it was the rise of digital networks and electronic trading. In the 2010s, it was Bitcoin proving that decentralized value could survive. And in the 2020s, it's tokenization and neutral settlement layers that are rewriting the rules again. XRP sits right in the middle of that shift. not as a speculative toy, but as infrastructure. That's why this moment matters. It's not about predicting whether XRP hits $10 or $30 by a certain date. It's about recognizing that the forces lining up, ETFs, supercycle liquidity, tokenization, global macro shifts, are all converging on one outcome, a systemic repricing of assets that actually solve real-world problems. XRP isn't promising the world. It's already doing the work. And as the world catches up, valuation will follow. Here's the mindset shift I want to leave you with. Don't think of XRP as just another crypto. Think of it as the pipes under a city. When pipes are first laid, nobody pays attention. They're boring. They're invisible. But once the city grows, everyone depends on them. And the companies that own those pipes become indispensable. That's XRP's role in this next wave. It's the invisible layer that makes everything else possible, from tokenized treasuries to cross-border trade to programmable liquidity. So what should you do with this information? First, understand the timeline. We're not talking about decades. We're talking about a 2 to 5 year window where systemic adoption collides with thin liquidity. That means positioning early, before the headlines and before the stampede. Second, focus on conviction. There will be volatility, there will be fear, there will be days when it feels like nothing is happening. But conviction is what separates those who profit from those who panic. Third, protect yourself. Diversify, manage risk, and never overextend. Being early only matters if you're still standing when the payoff arrives. And finally, zoom out. Wealth cycles like this don't come often. Most people go their entire lives without ever being in the right place at the right time. You are here now with knowledge that billions of others don't yet see. That is your edge. Use it wisely. Prepare, position, and hold your ground. Because when the dominoes fall, when the supercycle wave crashes into the financial system, XRP won't just move, it will redefine what we thought was possible. The next 2 years are not about hype. They're about discipline. They're about staying informed, staying patient, and staying ready. And when the history of this supercycle is written, those who acted now will be the ones remembered as visionaries, not because they predicted every twist and turn, but because they saw the bigger picture and refused to blink. So as we close, I'll leave you with this. Every market cycle has its defining asset. In the dot-com boom, it was Amazon. In the gold rally, it was the miners. In crypto's first wave, it was Bitcoin. In this 5-year supercycle, it may very well be XRP. And when that reality hits the mainstream, the repricing won't be gradual. It will be violent, it will be global, and it will be life-changing. Don't wait for the headlines. Don't wait for the crowd. Position yourself now while disbelief still dominates. Because when the shockwave arrives, it won't just change markets. It will change lives. Like, comment, and subscribe for more.